Well, hello again, Solis Wealth family. Greg Solis here with the market update. First, on the family front, Monica and I had the privilege of actually going to Barcelona. Had never spent much time there in Barcelona, but we had a great time. LPL actually does their, once a year, they have their so-called summit conference there. And I get to go there with some of my peers and some of the home office people, and just a great opportunity to talk to some of the home office and talk to our chief economists or all of our strategists and just really kind of network with some quality people. So we had a great time. Good to get back. Unfortunately, while we're gone, the markets got a little bit crazy, which brings me to that. What a tough week it was with what took place with Silicon Valley Bank and Signature Bank and some of these issues that took place. And it certainly reminded me of what we went through about 15 years ago during the 08-09 debacle. That was the first time that a bank that large since Washington Mutual, where the Fed had to step in and help them out. So a challenging week to say the least, and it certainly brought some concerns to the market and what might be going on. But here's the bottom line of what we see. This, although it has the same feeling of 08, it's a different situation. We were dealing with subprime securities back then, a lot of synthetic, kind of complicated things going on at that time. In this case, it was just real simple. The Fed raised rates a lot, and a lot of these bond prices got pushed down. And unfortunately, this bank had a lot of those securities in their portfolio. And of course, those prices went down quite a bit. As you've heard me say over and over again, when interest rates go up, the value of bonds go down. And so their balance sheets got a little messed up, and they had a kind of a run on the bank. And this day and age, you can move money so quickly if the word gets out, and social media hears that, oh, there's some challenges. People are trying to all withdraw at the same time, and that's what happened. And so we don't see this as a systemic problem overall. We think that it'll probably be short-lived, somewhat isolated to some of these regional banks, although this was a large bank with over $200 billion. It was a big deal, but we don't see it as an ongoing thing. And we see this, of course, being more specialized in the banking that they were doing with venture capital, and Signature Bank dealt with cryptocurrencies and things like that. So a little bit of a different situation. Hopefully this will be short-lived. The market did give back most of what we had gained in January, February, and March. Certainly saw a pullback, but we're still up a little bit year to date on the equity markets. But the bond market held up pretty good because interest rates came back down. When all this went down, there was what we call a flight to quality. And so interest rates came back down, which pushed bond prices up a little bit. So finally, we're getting a little bit of that counter correlation. Stock market was down, bond market was up over these past couple of months. And so that's helped level out some of the performance of the portfolios. So overall, hopefully this will be short-lived. We're anticipating that the Fed might have to slow down on raising rates. Maybe we'll just see 0.25% now on March 22nd instead of 0.5%, or maybe they'll hit pause and not raise rates at all. If that happens, we might see some rallies in the market. So hang tight. I know it's unsettling when you see these things going on, but we're on top of it. We're watching it closely. We will keep you posted. If you have questions or concerns, never hesitate to call. My very best to you and your family. Look forward to seeing you soon. Take care and God bless.